go through two problems in Chapter 3 doing absorption and variable costing. So please print out this handout so you can follow along. You also have the solutions to this handout. So we're going to, the handout actually has the discussion questions on it. I'm not going to go through those discussion questions, but please go through them. They're very important. And there's the answers to the discussion questions. And here's a solution to the problem. I have added a few more lines in mine, which I'll explain later. But anyway, we're going to go through exercise 23 and then, get over here on the right one. And then problem 1, you actually have problem 1A in here, so it might be good to walk through problem 1A since you have it as assigned with different numbers. Okay, so first of all, let's talk about why we have absorption and variable costing. So I'm going to lost my video. Pause this video a second and set something up. Okay, so looks like a blank screen, doesn't it? Okay, so let's say you have a supervisor salary, and that supervisor salary for the year is $20,000. Small low salary there, but anyway, we're going to work with that. $20,000. Okay, and the question is, how much of that I've got $200,000. So we'll say we have a couple, 2 or 3 supervisors. Salary of $200,000. Let me make this bigger. Okay, and the question is, how much of that $200,000 gets on the income statement? Okay, well, if I make 100,000 items, I made a million. Okay, if I make 100,000 items, the question is, again, how much of this $200,000 gets on the income statement? All right, and the answer is it depends. It depends on whether it's a product cost or it depends on if it's a period cost, okay? Because if it's a product cost, the cost attaches to the product and gets on the income statement when the product is sold. If it's a period cost, the cost attaches to the period and gets deducted on the income statement in the period. Okay, so remember we have sales minus cost of goods sold, and hopefully you know this by now, is gross profit, is operating income, or minus operating expenses, gives us operating income. Okay, and so basically if it's a product cost, it's going to go through cost of goods sold, and if it's a period cost, it's going to be operating expenses. So if it's a period cost, if that $200,000 is let's say the accountant's salary, the CEO's salary, the answer is it's a cost of the period, which is last year, and the answer is $200,000 is going to be expensed on the income statement. Okay. However, it's that's a period cost. Supervisor salary, remember, operating expenses are period costs. Period costs are selling and administrative expenses. So selling and administrative expenses would be the salesman's salary, the president's salary, the lawyer's salary, the accountant's salary, etc., etc. If it's a product cost, I need to say, all right, how much attaches to each product? So if I have $200,000 of the supervisor's salary, the cost of goods sold is made up of direct materials, direct labor, manufacturing overhead. So basically, I'm talking about all those overhead items. So I made 100,000 items, and it basically I'm going to get $2 per item. Okay, so now the question is, how many did I sell? So inventory is either sold or not sold, and if it's not sold, it's an ending inventory. So let's say of the 100,000 items, I sold 80,000, and therefore I didn't sell 20,000. Okay? I'm really having trouble with typing zeros today. Okay, so if I sold 80,000, then 80,000 times 2 goes on the income statement, and the 20,000 times 2 stays on the balance sheet as inventory and when it's sold next period. So the answer is, if it's a product cost, The answer is 160,000 because I have expensed how much is sold. If it's a period cost, it goes in the operating expenses. Okay, that's GAAP. That's absorption costing. The reason we have absorption costing is all costs get absorbed into the inventory at $2 per unit, and then with the matching concept, it says I match my expenses with the same time period as I make my revenues. And so therefore, if I sell 80,000, I need the cost of 80,000 to match against those sales of 80,000. And next period, if I sell the 20,000, then the 40,000 is going to go in cost of goods sold next period. Okay. However, in managerial accounting, sometimes financial accounting information needs to be tweaked to make it more relevant. So somebody may say, okay, well, let's say this is rent of $200,000. And I rent of the factory building. So I spread that rent over my 100,000 units, and it's $2 a unit. I sold 80,000, and so 80,000 goes on here according to GAAP because you want to match your expenses with the period, etc. But somebody internally may say, yes, that's great, and I understand that, but I want to put $200,000 on an income statement because I want to focus a little bit. Some people say it's more of a focus on cash flows, and I spent $200,000 in that period, and so I want the whole $200,000 to go on this. Okay? And remember, for managerial accounting, we can change the rules of GAAP because we aren't comparing firm to firm. We're just tweaking the rules for our own purposes. So you may do this sometimes in your own life. So for instance, let's say you buy a car and you think that car is going to last you for 5 years. And you buy that car for $30,000. Sometimes in your mind, you're going to say, okay, well, that car is going to last me 5 years. So $30,000 divided by 5, that's about $6,000 a year. But if you're doing more of a cash flow statement, you want to say, okay, I'm out $30,000 today. Or you might want to figure out on the loan, et cetera, et cetera. So what you're doing is you're tweaking the financial information to suit a different purpose. And that's what we're going to do in this chapter. So in this chapter, I'm going to pause this again. This chapter, we're going to have two kinds of income statements. One income statement is going to use the per unit cost, and the other income statement is going to use the total cost. Okay, the one that uses the per unit cost is called absorption costing. So I want you to, I've done this on Excel, then I'll show you their solution and compare it. But under absorption costing is sales minus cost of goods sold, and it's just the yellow items here. Sales minus cost of goods sold is gross profit minus operating expenses is operating income. All right. And then the other one is called variable costing income statement. You've actually done this so far in this chapter. Is sales minus variable costs. Sales minus variable costs is contribution margin minus fixed cost is operating income. And what we're going to find out is the two aren't always the same number. And the reason they're not always the same number is because if you think back to the problem I just showed you, sometimes I'm deducting the entire amount of fixed costs, and sometimes I'm just deducting what is related to what I sold. Okay, so make sure you know the framework for this. Sales, let's talk about absorption costing first. Sales minus cost of goods sold is gross profit, minus operating expenses is operating income. And then I'm going to kind of sandwich in the format for the cost of goods sold statement. So cost of goods sold is beginning inventory plus what I manufacture gives us available minus ending inventory gives me cost of goods sold. Okay, and then my operating expenses, I just broke them out. You're going to find out the solution just puts this $13 million on there, but that's okay. Okay, so let me kind of get this a little bit larger, and I'm going to work in units first so I kind of understand it. So notice that I have beginning inventory, and notice they're just giving the units and the cost. So a lot of times you'll be given this number and this, and then you can back into the unit cost. Okay, so 3,600,000 divided by 24,000 units should be $1.50 a unit. Okay, so anyway, and then I split it out between number variable and fixed for each of these. Okay, so notice here, this is manufacturing costs, and this is manufacturing costs for June. So this is manufacturing costs for beginning inventory. This is for June, and this is selling and administrative. They don't have selling and administrative and beginning inventory because selling and administrative are period costs and they're costs of the period. So I can show you right quick. See this 1215972? They're right here because they're costs of the period. So I'm going to expense it in the period that they happen. Okay, however, manufacturing costs do have this beginning inventory thing. Okay, so under absorption costing, I'm going to have both variable and fixed costs flow through the cost of goods sold statement. Under variable costing, when we get over here, which I'll explain later, you're only going to have variable costs flow through the cost of goods sold statement because I'm going to treat fixed costs as total costs. So like the one I just said, I want to expense the entire $200,000 or $20,000 worth of costs in the period that it happened. And again, this one is financial statement purposes. This is internal purposes because I need to use it for a different reason. So again, just like in your life, you might take the same financial information and tweak it for a different purpose. We're going to do that with financial accounting. Okay, so the first thing I'm going to do is kind of get control of my units. So I have 24,000 units that I had in beginning inventory, and then I made 246,000 units. Okay, this 150 and this 150, it's just coincidentally that it's the same. Your book might make them the same a lot, but certainly variable manufacturing costs are direct materials, direct labor, and variable overhead. But I think you know people can get raises, so this can certainly change, or our materials costs can go up. So you can have a different unit cost for beginning inventory than current period costs. So these do not have to be the same. But remember, I'm just doing units. Okay, so if I have 24,000 units I start with, and I made 246,000 units, I've got 270,000 units available. So this is beginning inventory, and this is items manufactured. So this is available. Okay, it's probably a good thing to do this so you can do it. Okay, and then we can remember that inventory is either sold or not sold. So if I subtract how much is not sold, I can get how many is sold. All right, it doesn't matter, you can do it either way, but in this case they tell me how much is sold. So if I have 270,000 units sold, my ending inventory is 0. And it's pretty important that you figure out what your ending inventory is, and you'll see why in just a second. But my ending inventory is 0, and that's pretty important. Some problems, you can have ending inventory. I don't think this book gives you both beginning and ending inventory, but it's good to write it out. So I'm going to change this from units. So right here, this little thing right there. I'll make it gray. Okay, this is in units, and I'm going to do it in dollars now. Okay, so now what I'm going to do is, you can see my numbers up here, but I'll type those in again. My beginning inventory is 24,000 right here, and I want, for absorption costing, both variable and fixed costs. So I'm going to multiply it by 182.80. Okay, so I have beginning inventory of 4,387,000. So again, I'm just putting dollars to this. And then I manufactured 246,000, and I want both fixed and variable because under absorption costing I put both fixed and variable. So I have 246,000 times my 186. Okay, notice again that what happens is I take to get my per unit. So if you have a problem that doesn't give you your per unit, it's the 787,200 divided by my 24,000 units to gives me this. 8856 divided by 246 gives me that $36 each. Okay, so now I have available of 50143. I subtract my ending inventory, so if I sold, let's say, 260,000, I'd have 10,000 ending inventory. And we usually assume a FIFO basis, so first in, first out. So these are gone. So my ending inventory would have a per unit cost of 186. Okay, so they'd come from all the most recent purchases. But I did indeed sell them all, so I have 0 ending inventory and I have cost of goods sold. Okay, so that's just 50143 minus 0. Sometimes you can kind of do a shortcut. I'll do it over here. Notice that I could say, all right, I sold all of these and all of these. So I sold 24,000 at 186 and 24,000 at 182.80, 260.46 at 186, and I can get my total cost of goods sold. So sales minus cost of goods sold is gross profit. Then I'm going to do my operating expenses. So again, an income statement is always based on number sold. Okay, so rarely, if you're going to go straight here, you'd be 270,000 that you sold, but it's got two different costs, 182 and 186. Okay, so my operating expenses, they give me the total, which is this number, but I could also do 270,000 because I sold 270,000 times 45, and then I have fixed of 972. So 13,122 plus these two, I just added these two, so plus E12 plus E3. E12 and E13. Okay, so I added those, and so I have my operating income of 1,734,800. So sales minus cost of goods sold, which is both variable and fixed, gives us gross profit, minus my operating expenses gives me operating income, 1,733. Okay, so I'm going to pause this a second and show you the solution. Okay, so notice in the solution, they basically do the same thing. They just leave out this ending inventory, which I hate to because the next problem actually has ending inventory. So we have sales, 81 million, which is my 270,000 that I sold, times the $300,000 selling price. Just read your problem. This is given. Okay, I'm going to assume you read the problem. I didn't read it to you, but you can read it. So this selling price is given in the problem. A beginning inventory of 24,000 times 182, so 437. I have cost of goods manufactured. Since they don't have an ending inventory, they just flip right to cost of goods sold. So I prefer showing the ending inventory just so you can see it, and I can use the same template for the next one. Then my selling and administrative expenses, I broke them out between variable and fixed, and I have a reason for that. But notice 13122, 13122, and my operating income is 17. Okay, so let's go to the variable costing one. All right, under the variable costing one, let's go over here. Okay. I still have the same amount of sales, so I sold 270 at $300 per unit. So 270 times $300 per unit is 81 million. So notice it's the same as over here. Okay. Then I'm going to have my subtract. The format for the variable costing is sales minus variable cost is contribution margin minus fixed costs is operating income. That's the format for the variable costing one. Okay, so on my variable cost, I have two types of variable cost. I have manufacturing variable cost and operating variable cost. So I've made my green item here my manufacturing variable cost, and this little white line there is my operating variable cost. Okay, selling and administrative. All right, so in variable costing, I simply only take the variable cost. So it's make sure you get the right thing. So my beginning inventory is 24,000 times 150. So notice 24,000 times 150. Then I should put this, what I manufactured, so cost of goods manufactured. Only variable costs. So look at this. I have 2,246,000 times 150. And again, this is just a coincidence. That number is the same. Okay, this gives me available of 40,500,000. I subtract my ending inventory, which is 0, and then I have my variable cost of goods sold. You're going to find out in the solution, since the costs were the same, 150 and 150, I could have just taken, and I know that I had no ending inventory, I could just take 270 times 150, and I get the same number there. Okay, okay, then my variable operating is 270 times 45, which is the 1.25, so that's there. So now I have my total variable cost, which is variable manufacturing and variable operating. Okay, so I'm just adding these two numbers together, right there. Okay, so delete those. So sales minus variable cost is contribution margin minus fixed costs, and in variable costing, fixed costs are fixed. So I want my fixed manufacturing. I do not want beginning inventory, because beginning inventory was last period. So I only want fixed manufacturing for this period. I'm making fixed costs a period cost. So look right here, the 8856 is coming across there, and the 972 is coming across there. So sales minus variable cost is contribution margin minus my fixed cost, which is just these two numbers added together, gives me my operating income on variable costing of that. Okay. So now the question is, let me show you their solution. Oops. Okay, so they have the 81,000 or 81 million variable cost of goods sold. They just took the shortcut method, 40,500, 40,500. They have manufacturing margin. I should have added that in there to subtotal after that for manufacturing margin. And variable selling and administrative, 1250. Fixed manufacturing, fixed manufacturing, fixed selling, total fixed cost, income from operations, operating income. Okay? So now the question is, let's reconcile the two and make sure we figure out why the two are different. So make this right over here. Okay. So first of all, I wanted the difference. So under absorption costing, it's the 17, that number. And under the variable costing, it's 18,522. So it's 787,200. Okay, this is not a reconciliation. That's a subtraction. This is our reconciliation. All right, so if we think about it, I want to show you something here. This is why I kind of like to split them up. I'm going to have to change these to maybe bright yellow. Okay, this number, variable operating. Notice it's the same on both sides. Fixed operating, it's the same on two sides. Okay, then I have variable cost of goods sold, and I have cost of goods sold over here. And the reason it is different, quite frankly, the variable portion is the same under it. It's just simply the fixed portion that's different. So both of these numbers have $150 of variable cost, but it's the fixed cost that's different. So why is it different? Well, because this one right here, I put, go back to the problem. So this one, notice it was the total cost for the period. So in this period, I made $246,000. And they each had a unit cost of $36. So I have the 8,085,600. Okay, so look at that. That's the 246,000 times 36. However, over here in my variable costing, I had total of 24,000 times 32.80. And I had 246 times 36. Okay, now you're not seeing this number. I'm going to pause this one second. Okay, so you're not seeing this number up here because I have variable and fixed buried in it. So notice that I took in this one, look up here, I have 24,000 times 3280, and I have 246 times 36 in this number. Okay, then I'm going to just show you what I had the variable. So my variable costs were 24,000 at 150 and 246 at 150, which totaled up to 270,000 times 150. Okay, so notice that once I add both my variable and fixed cost per unit, I have 5,143,000. Okay, another thing I could have just done is said, all right, let me add this. Here's my variable costing here. So I take my fixed cost I put in cost of goods manufactured, and my variable cost I put in cost of goods manufactured, and now I have variable and fixed costs in cost of goods manufactured. So I want you to notice something. The difference between these two was 787,200, and it's right there. It is that number. It's my beginning inventory that I have buried in this statement that I don't have on this statement. Because on this statement, I simply have the total fixed manufacturing costs, $8,856, and on this statement, I have my $8,856 plus my $787,200. Now this is nice and neat because I have zero ending inventory, but if I have ending inventory, I'll have both of them. Okay, so I'm going to pause this a little bit, then go on to 1A. Make sure you actually look through these statements, practice this. These two chapters are probably where most people get lost, and quite frankly, it's just because you don't practice. If you don't practice something, you're simply just not going to get better at it. Let me cue up problem 1A. Okay, so in problem 1A, notice it's our first month of operations. So what's going to happen in this one is we have zero beginning inventory. Okay, so I'm going to put zero beginning inventory over there, and I'm going to put zero beginning inventory over here. Okay, all these other numbers are still left from that prior problem. Okay, so now I manufactured 80,000 mini refrigerators, of which 72,000 were sold. Okay, so if 72,000 were sold, I want my income statement based on the number sold. So I'm going to prepare my income statement and my under absorption costing and my income statement under variable costing. Okay, so not given my sales per unit, but let's actually make a per unit cost column on this. And actually, I'm going to just do it over here, down here, and hopefully you'll write it out over there. Okay, so I have 10,800,000, and I'm going to divide that by the units sold because that's sales. And so I have $1.50. Okay, so now I'm going to do the 6,400,000, and these are manufacturing costs, so I need to divide those by the 80,000 manufactured. Okay, so I want you to put 80 next to this one. And then I'm going to have the 1/6 divided by my 80,000. Again, these are all manufacturing costs. So I have 20. And then I have my, hopefully I have all these numbers right. Okay, so now I have my variable manufacturing costs. Okay, so I want you to write 116 there. I think I can probably write, but it's gonna, 116 per unit, okay? All right, then I have my fixed manufacturing. And again, I want it divided by the 80,000 units sold, so that's $4 per unit. Doing that for a reason. So this is my fixed manufacture. All right, so my total is 120. Okay, so I'm going to have $4 here, and then a total of 120. Please make sure you write that down. All right, for the variable selling and administrative, if you want to, generally the totals are fine, but 10. And since these are selling and administrative, I need to divide them by the number sold. So that's 15, and fixed is fixed, so I don't need to do that. So you can write 15 here. You're going to find out you don't need it, but if it helps you out, make sure that you know that technically we tell it. Okay, so let's go up here. All right, so I have, how many did I manufacture? I manufactured 80,000, and I want to multiply it by my total cost, which is 120. During the period, notice I have no beginning inventory. So I have 960. Now I have, let's do units here. I have beginning inventory of 0. I manufactured 80,000. So I have 80,000 units. My 72,000 was sold. So if I want this to be 72,000 here, my ending inventory units are either sold or not sold. So I have 8,000 units in ending inventory and 72,000 units sold. Okay, so sales is based on 72,000 units, so 72,000 units times my selling price. I'll pause and figure out where my selling price is. Oh, it's given.